I mean, going back to 1933, you had $20.67 to an ounce of gold. Now you've got $3,400 to an ounce of gold. Well, what does that tell you? Does it tell you gold's gone up? No, it tells you the dollar's gone down. It's not prices going up, but it's the currency going down. And when people actually do understand that, when the general population understands that, the currency is doomed.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 21st through July 28th, 2025, while supplies last. First this week, we have a special on pre-1933 gold. MS62 $20 Liberty coins or MS63 $20 St. Gaudens coins
are just $90 over melt. Own a piece of American history at just $90 over melt.
Next, backdated 1-ounce Platinum Eagles are only $270 over spot. And finally, Dealer's Choice 90% Constitutional U.S. Mint Silver Dimes and Quarters are just 65 cents over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted and privileged to have this distinguished returning guest. Alasdair Macleod, a former bank director and head of research, joins us this Thursday, July 24th, 2025. Alasdair, thank you for coming back on Liberty and Finance.
That's my pleasure.
Our viewers have been keenly watching the metals markets, especially the progress of silver against gold, but both of them holding up remarkably well and rising over the past quarter and the last week or two. In addition to that, you've recently written an article asking the question and examining it from your perspective on whether there's likely to be a sharp drop in metals prices following this recent run-up. Can you bring us through your thinking on that and where you came to as part of that analysis?
Yes. I mean, obviously, there's always volatility in the prices of any commodity. But what I did was I thought I ought to have a look at metals prices in the context of the longer term, and particularly silver. Now, silver has been behaving as an industrial metal, and I've got, if you like, a basket of base metal prices going all the way back to 1900. And if you price that in gold, that is quite revealing. Bearing in mind that over reasonable periods of time, and I'm talking about decades, centuries, millennia even, the purchasing power of gold is relatively constant. I mean, the reason for this is that gold is accepted everywhere as money, and unlike Bitcoin, the supply increases, and it increases at a rate which, while it can vary, is more or less in line with the global population. So you have a stability, if you like, when you price anything in gold. And we certainly saw this up until the point where the Bretton Woods standard collapsed. The point is that if you take the prices at the beginning of the last century, so we're talking about over 127 years, you can see this stability in a basket of base metals priced in gold. But interestingly, recently, the value of these base metals priced in gold has actually declined quite significantly. And this year, it's standing at a roughly 77% discount to that 1990 level. Now, it always returned back to that level. Sometimes it'll go over, sometimes it'll undershoot, whatever. But what that indicates is that irrespective of what's happening to fiat currencies and their purchasing power, these base metals as a package, we can expect them over a period of time, we don't know how long, to increase roughly 3 to 4 times. Now, that is before you talk about the debasement effect of fiat currencies on metals prices. Now, this is very important. What it tells us in a nutshell is that base metals are more underpriced than they have been in the last 127 years. 25 years, sorry. This is really quite something. So this has significant implications. We're not just talking about base metals, but if we're looking at other commodities, you're going to get a similar sort of message. And therefore, the implications for consumer prices, let's say on a 5 to 10 year view, is that they're likely to go considerably higher. So the rate of inflation, if you like, even though the government suppresses the numbers, will increase. But returning to silver, silver has been priced like one of these base metals, and there's nothing in it at all in terms of premium for its monetary role. But I think that is also going to return because gold is very, very under-owned, and it's a racing certainty that as members of the public begin to catch up with what's gone on in gold, they will, at the margin, prefer to buy silver rather than gold on the basis that gold has already gone up and silver, has been left behind. So what we're looking at, in answer to your question, is silver is definitely on a tear and it's going to go considerably higher. And it's been doing it since I wrote that article. And I see this continuing. As far as gold is concerned, it's just been consolidating sideways. It's extraordinary how it's just moved sideways for the last, 2-3 months, consolidating and really providing a platform for the next rise up. In technical terms, we have what's called a pennant. Some would call it a triangle. And that triangle consists usually of about 5 legs. You go down, up, down, up, down. Now, we're on the final down leg. And this actually coincides with option expiry for the August contract, which is on Monday. So I would expect to see gold drift off a little bit, but we're talking, 1-2% sort of thing. This is not meaningful in the scheme of things. The other thing I would throw in is that this underpricing of metals as a whole is now leading to indigestion, if you like, in the papers markets. If you look at the best performing commodities this year so far, platinum, palladium, copper, silver, gold. It is extraordinary. And this is reflecting just how undervalued metals as a whole, precious or otherwise, have become. So anyone who thinks that there is going to be a decent reaction in gold and they're going to be able to get into it and all the rest of it, I think they're going to miss it, I'm afraid. And that's the way it is. It's very under-owned. If you look at the other way of looking at this is this is gold, admittedly, but it's estimated that total portfolio assets around the world, global assets, are in the region of, I think the 2023 figure was $270 trillion. If you look just at the ETFs, that represents less than 0.2% of that. I'm talking about global ETFs. Now, the reason I would say ETFs is that in most of the world, in terms of portfolios, you have got investment regulation, and gold is not a regulated investment. So it's actually quite difficult for an investment manager to put raw gold, physical gold, into a portfolio because he's got to argue the toss with his compliance officer. And, do you want to do that? No, you don't. So what you do is you buy a gold substitute. That is why I think that the gold substitute in the form of ETFs, which is a regulated investment, is a fair indication of the level of gold interest in portfolios. Now, obviously, there is an element of wealth, and a fairly large element of wealth, like say a larger element of wealth than ETFs, privately held as private wealth, not part of, if you like, the sort of regulated investment scene. So it's not recorded, if you like, in ETFs. But nonetheless, that's very concentrated in Asian hands. We know that. But when it comes to US, when it comes to UK, when it comes to EU, and when it comes to, our friends in Australia and Japan and so on and so forth, gold is very under-owned. So if you get some sort of crisis and a flight into the dollar, which is what happened in 2008-9, people haven't got the gold to sell. They'll sell something else. So this is why I feel the downside in gold is very limited. And of course, the other thing is, and this is desperately important, it's not so much the gold price has been rising, but the dollar has been falling. And so much so that we've even seen this in the trade-weighted index. So in short, there is a lot of catching up to do. And I think it's all part and parcel of the swan song, if you like, of fiat currencies.
That's what I wanted to get to with you, is our viewers are keenly interested in real things, in stable assets that are going to carry them through challenging times or help to protect and ensure their family's future from volatility that can come with upsets in other areas. There's all nature of types of preparations that we've talked about for years, physical preparations for the unknown. This is a keenly important one to us because we've seen such a runaway increase in volatility, not only of financial markets and the bond market and the fiat currencies, the dollar itself, for example. You've talked to us several times about how it's often the domestic members of citizens of a country that are the last to open their eyes and awaken to the demise of their currency, that the foreigners tend to realize it earlier, take action earlier, and to be less entrapped by normalcy bias about a currency's demise than the people who are living in that country. Can you bring us up to date on your view of the dollar itself? Because a lot of the discussion that you just went through, you started to, and I was delighted to see this, you started to talking about things measured relative to gold rather than just relative to the dollar, which is what most people think about, most people talk about. But frankly, for many ordinary mom and pop savers and investors, their dollar-denominated view of their savings account, their bank balance, their equities, the stocks they may have, and that sort of thing is what predominates in their mind. It's how we tend in the U.S. to measure our preparedness for retirement or for financial stability. But you made a big point recently that that's not how you should be measuring your preparedness for the financial future. Help us understand that.
Yes, I mean, what you say is perfectly natural because you account in dollars and you pay your taxes in dollars. And so from the point of view of whether you're up or down, your risk-free position basically is cash dollars. But this is all an illusion because what you're looking at is credit. It is a credit risk, which depends on your faith in the Fed. And because it's a federal dollar, it's the Fed's dollar. And in turn, of course, the faith that you might have in the Fed is going to depend very much on the faith in the US government. Now, the reason that foreigners probably recognize this first and domestic users of the dollar recognize it last is obvious because foreigners, from their point of view, their risk-free position is their own currency. So, let's say, a Brit investing in dollars or whatever, he sees risk because he is accounting in sterling. He pays taxes in sterling. He makes his profits in sterling. So you can see that foreigners are a lot more sensitive to what's going on, let's say, in a foreign currency than domestic users. Domestic users, they don't actually understand, the difference between money and credit, gold being money and the rest being credit. And the second thing is that they assume that all the price changes they see prices rising. They think it's not the dollar going down in terms of its purchasing power. They think it's items rising, for whatever reason. I mean, they call it inflation. Actually, inflation is a description of what happens to the quantity of credit is a complete misnomer when you're talking about what's actually happening to prices. Prices are rising, they're not inflating. Now, that's a different thing. The only way to look at it really is to understand that the dollar's value in transactions is not a constant. It is something that is moving all the time. And for a long time, it's been moving downwards. I mean, if you look at it in terms of gold, I mean, going back to 1933, you had $20.67 to an ounce of gold. Now you've got $3,400 to an ounce of gold. Well, what does that tell you? Does it tell you gold's gone up? No, it tells you the dollar's gone down. And we've had a constant stream of crises ever since 1933. First of all, there was the devaluation of the dollar. I mean, this is an interesting one because people will say, well, they rose the price of gold from $20.67 up to $35. Really? Actually, what they did was they devalued the dollar by 40%. And then, of course, you had the Bretton Woods thing in 1971, driven off Bretton Woods. Nixon said he suspended it, to stop foreigners speculating and all this sort of garbage that politicians talk about when it comes to what they think is money. But they were driven off it because basically what was happening is that as long as they fixed the dollar at 35 to the ounce, foreigners were just, saying, well, here, you can have my dollars. I want the gold at that price. Thank you very much. And from about 1947, 8, round about then, America had 22,000 tons of gold in its reserves. And by the time Bretton Woods was suspended, that went down to 9,000 tons. They were clearly running out. And, at the time, they were having to sort of sweep around, see what they could find left in the Fort Knox vaults. And, a lot of it probably wasn't actually deliverable into markets. So that's what happened. We've got, for example, in the UK, as late as 1935, the gold sovereign was worth £1. Today, one sovereign is worth £600. Is it because the sovereign's gone up? No, it's because the pound is rubbish. It's gone down. So this is the message which everybody's got to understand. And this is why the last people who understand it are the people who sort of wake up to the fact that it's not prices going up, but it's the currency going down. And when people actually do understand that, when the general population understands that, the currency is doomed. We are not there yet, but we will go there.
It's remarkable because I just, for example, last night had a call from a client who said, I have come to believe that the dollar is going to be damaged even faster, that I need to be in silver, he said now, and I need to get particularly, I need to get my funds out of the bank and get them into hard assets like silver. And this is that shift in perspective, that pivot from that we were told as children, you got, it's as good as money in the bank. And that was what we were told. I've got to get my funds, my nest egg out of the bank, out of the system and into something that's going to hold value is like a light bulb that goes on for people when they finally awaken to come out of this sleepwalking trance that you tell us that the holders of domestic currencies need to escape from in this era of fiat currencies that are going down the drain. How do you view all fiat currencies of the world? Because some people say, oh, the dollar was strong against, as the Dixie, the dollar index against other currencies, etc. But now the dollar hasn't even been doing very well in that arena. What's your view of currencies in general or in the fiat world at this time and the dollar specifically?
Well, they're all in the same boat. Just look at it from 2 points of view. In the G7 nations, all, they've all got high debt to GDPs, and when interest rates rise, and they are rising, do not believe that they're falling. If they fall, they're being suppressed, and that kills the currency. You can see that which way this is going for all these currencies. It's almost like a race to the bottom, if you like. The thing about the dollar is that the dollar is the most important fiat currency. And there will come a time when the Dixie starts rallying for the very simple reason that everything else is falling faster than the dollar. That I think is going to happen. My own view on sterling is that sterling is in it's in a huge, great mess. Or more accurately, I'd say that government finances are in a horrendous mess. And so far, this has been ignored because where is the attention? The attention has been on, your wonderful President Trump and all his running around and upsetting things and all the rest of it, and trade and big, beautiful bills and so on. So, in terms of bad news, he's been stealing the limelight. That's going to shift. It will shift at some stage. I don't know when. I don't think it'll be terribly long. So the idea that the Dixie is going to go down and down and down and down is actually not the way to look at it. The dollar is going down and down and down against gold, not Dixie. I mean, I can see that Dixie falling to 90 from the current, 97.5, 8, something like that. That wouldn't surprise me at all. But in the grand scheme of things, that's not all that important. Some people argue that President Trump wants to see the dollar lower. I think he's talked about it. He certainly wants interest rates lower. And I think his attack on Jay Powell is actually very misguided. I think that's a very stupid thing to do. It's completely nonsensical. As indeed, from a foreign point of view, most of his trade policies are completely nonsensical as well. So, all other currencies are basically in the same boat. And we can see that the yields on longer JGBs are on the rise again. I think we're hitting new highs for 20 odd years or something on the yield on the 10-year JGB. And if you go longer, apparently there's absolutely no market in the 30 and 40-year-old maturities. What's going to trigger a new phase in this crisis? We just don't know. With everybody in the same sort of mess, to greater or lesser degrees, it could come from anywhere. And which makes me think that anyone who sort of thinks, oh well, we'll muddle along a bit longer, I think it's holding a hostage to fortune. I really do.
My mind pictures a metaphor of a team of skydivers who are all falling. They're all in free fall. When you talk about all these various fiat currencies of the world, they're all losing value against real things like gold, like silver, like real commodities. And they're all falling at various rates and speeds, and they aren't entirely linked hands. There's some are falling faster than others, and so whether the dollar is at the moment falling lower and faster than the others, and later on it'll float up. As a scientist and as an engineer in my professional background, it's very critical they say always pick what is your coordinate system. Make sure you're clear on that before you start making any conclusions or measurements. And if your coordinate system is on an axis that's dropping like a rock, then you're going to see things in a distorted manner. You're going to see relative positioning by these different fiats that are all falling, but they're falling for crying out loud. What's much more important to grasp is not that they're jockeying for position between themselves, but that the whole frame of reference that you've been using is no longer appropriate or no longer sustainable long term, because pretty soon that whole frame of reference is going to hit down. It's going to hit bottom. You've just recently written about a major piece of legislation that got signed, the Genius Act, it's called. You've also written and spoke with us last time about your view of cryptocurrency in general and Bitcoin in particular as whether or not it qualifies as money. Your conclusion was it doesn't behave the way money needs to behave by the classical definition of money. There's been concern on the part of our viewers and subscribers about some proponents of crypto and some of the components of the big, beautiful bill that you just referred to a few moments ago, because it places a moratorium on states' rights for objecting to or blocking any aspects of AI rollout, and some aspects of crypto are related to that. So there's this almost like a steamroller that seems to be coming our way in the form of crypto assets and stable coins being pushed from the halls of power, which is ironic because they were supposed to be democratizing and liberating and grassroots and decentralized and all that. And all of a sudden we've got the halls of centralized power seeming to come out saying, oh yes, after all, let's stop putting restrictions on cryptos and let's embrace them and rally around them. So can you talk to us about your recent article about the Genius Act that you just penned and what our viewers need to know about it?
Yeah, well, there are 3 acts that have come up. The first one has actually been passed now by both Congress and Senate, and then that is the Genius Act. The 2 further acts, which are still progressing through the legislative process, one to move regulation of stable coins away from the away from the SEC to the CFTC, Commodity Futures Whatever Trading
Commission. Yeah.
Commission. Yeah. And the last one, which is very interesting, is banning the Fed from issuing a CBDC. Anyway, we'll forget about the one of moving from one regulator to another. I mean, that's just shuffling the deck chairs, isn't it, really? So we won't worry about that. But Genius is interesting because what it does is it embraces stablecoins. I think that there are 2 reasons for this. The first is that stablecoins issued by the banking system impart no risk to the banks at all. And the great thing about it is that you can expand your stablecoin exposure as much as you like. Well, the reason for this is that if the bank issues a stablecoin to a depositor, the other side, on his asset side, under this legislation, Genius legislation, basically, he's got to go and buy US T-bills or whole cash or readily accessible cash. In other words, he's got absolutely no risk at all. In the sense that 3-month treasuries bear no risk at all. I mean, this is you and I might dispute it, but this is regulatory fact. Okay, that's the point. So, I mean, at the moment, I was looking at the 3-month T-bill, and the yield on there is about 4.35%. So you pick up 4.35% on the other side, and you are banned from paying any interest on your stablecoin. So you've got a clear margin, no expenses. I mean, how wonderful is that? Of course, the banks embrace this. I think the problem is that the expansion of stable coins. I mean, at the moment, I think it's around about, I can't remember the figure, something like 300 billion or something. It's not huge. But the expansion of that market isn't actually tied to banks saying, oh, we got this wonderful new stable coin product. You go switch over your deposits, which give you 2% or whatever, and buy these things which give you nothing. I mean, that's not a very good marketing ploy. So I really just don't see that there is any other driver for this than the expansion or not of crypto use. They're used in payments and settling, and that's where the regulation is being applied. So that makes sense. I think the Treasury quite likes the idea. I mean, it's got no objection because it helps fund at a time when it's having great difficulty funding. The increasing amount of bonds which are being rolled over every year, as well as ongoing deficits. So the Treasury is quite happy with it. I think actually that, and here's an idea for those who want to, come up with a plan, and you're welcome to it. And that is, what you do is you put together a package. You put together a stable coin, an assembled stable coin, if you like, which is comprised 50% of gold bullion and 50% stable coin. What that means is that you can market this as portfolio diversification. Your stable coin is absolutely free of risk. Yeah, so you got your $50 as it were, and the bank merely, or the financial institution issuing the stable coins, merely buys in gold to cover the rest. Now, storage of gold is like 7 or 8 basis points in quantity, so that's cheap. Okay. And meanwhile, you got 3.75%, or 3.45% on half the total value to pay for those fees and pay for the marketing and all the rest of it. So suddenly we've got a product which gives sort of 50% gold backing for Joe Public in America. I mean, wonderful. So anyway, I would implore any bank looking for an idea to benefit from the stablecoin regulation, go that way and you'll make a damn fortune. You'll pull in the punters. Go for it. Anyway, I think, seriously, I think that's the sort of innovation, because banks and financial institutions are full of innovation. They will take something, they'll take legislation, they'll see the new regulations, they'll think, oh, now this gives us an idea. Yeah. And I think that's the way it'll go. So I think that's very good. The other bit of this crypto sort of legislation, of course, is the banning of CBDCs. Now, this is no surprise to me. We've talked about this in the past when we've discussed CBDCs. And I think I made it clear that I couldn't see the American banking system supporting CBDCs at all. And on the basis that legislation would have to be introduced to approve the thing, I would have thought that, because the banks basically bankroll all the politicians when it comes to their election expenses, I couldn't see the politicians being encouraged by the banks to vote for it anyway. I think they would say the reverse. If you vote for this, we'll cut you off at the knees. So the CBDC being chucked out and the Fed being told you cannot go down that route, I don't think is all that surprising. But it is terribly important, because the dollar is the most important fiat currency. And if the Americans have turned around and banned the Fed from going down the CBDC route, then I think basically it undermines the entire CBDC concept all around the world. We've had the ECB jumping up and down saying, we're only introducing CBDCs and all the rest of it. They're going to have to revise their plan. So if the Americans aren't doing it, they can't do it. It's as simple as that. So I think actually that legislation has done the world a favor.
One pause that gives me is that for as long as most people can remember, the title of most legislation coming out of Washington has the exact opposite effect of what its title seems to imply. So if the government is emphatically passing a bill into law that says this bill bans CBDCs, my spidey sense goes right up and says, wait a minute, what are they doing that's basically going to be doing all of the things that we were always told to watch out for from CBDCs, and doing it under a different name or a different title? Because we've seen that happen over and over again. I mean, for goodness sakes, the Patriot Act was what, according to the Ron Paul Institute on Peace and Prosperity, says is a cancer in the United States body politic, because it strips most Americans of many of their key constitutional rights and protections. Something to keep an eye on and to keep an eye out for. Make sure that we're not getting a wolf in sheep's clothing here. But any further thoughts from you on the direction and the outlook that you see for the metals markets in the midterm here? Summer often is a time of doldrums, and October is a time of slumps in markets. So people are looking into the third quarter with some head scratching going on as we head through the third quarter and into the fourth quarter. Your thoughts as we look ahead?
Yeah, it is. Can I just go back onto this CBDC thing? I think the CBDC thing, I think there's a dead. Your point about unintended consequences, I think probably applies to the Genius Act rather than CBDCs. Anyway, as to yes, I mean the summer months are very, very quiet. I don't know about in America, but over here, I don't see anybody's really sort of taking any decisions. What they're doing is they're sort of slumping into they're saying, oh, everything's terrible. The way the government's going is absolutely terrible, but they're not actually taking any action about it. I see polls which rather suggest that that's the same sort of drifting sentiment in America, if you like, and with even Republicans getting sort of rather depressed, if you like, about the whole thing. So I think action is likely to sort of revive, if you like. Usually it revives in around about sort of September time. August is still hot, and it's in the northern hemisphere anyway. And the kids are on holiday, and you're down at the beach, or where you're out somewhere drinking tequilas rather than taking life all that seriously. So you're trying to get away from it, from all this. But no, you're right. I think it is a summer thing. This is why sell in May and go away is usually right. It doesn't mean necessarily that markets go down. It just means that activity in financial markets declines. But the fact that gold has just moved sideways like that, I think, tells us that some trouble is being stored up for the dollar and other currencies later on this year. My view is actually that after this current, if you like, slight pause ahead of option expiry on COMEX and maybe one or two other factors like the sort of the expiry of the August contract, all this sort of stuff. I think that when that's out of the way, we could well begin to see gold move up quite substantially. And the point, I really do emphasize this point. I mean, with base metals so incredibly cheap on a long-term basis, the cheapest they have ever been in so far as we can record the information, the price information. That I think basically is going to propel the whole of the metal industry upwards, and we can already see these problems arising. There is a sort of horrible short squeeze in the paper markets on platinum, palladium, silver, copper. Copper is up 50% this year. I mean, imagine that. This is the most important of the base metals, Dr. Copper. And of course, gold. So, yeah, I mean, what an opportunity to just accumulate some of it, just stash it away. Don't worry if it falls 1% or 2%, or, it's immaterial because you're getting out of risk. That's the thing. That is the important point. So I think, dollar will be a lot lower. I mean, I'd put it that way. Dollar and other currencies will be a lot lower in the autumn than they are today. And that will be reflected in the value of real money priced in rubbish credit, which is dollars and other currencies.
Alasdair, you write frequently on these topics, and you have a new Substack that people are showing a lot of appetite for. Can you remind people how to find you and how to stay connected with your ongoing work?
Yeah, thank you. Thank you for the opportunity to place an advert, as it were. My Substack, alasdairmacleod.substack.com, or just, if you Google Macleod Finance, you'll find it. I've got getting up to about 20,000 followers nearly. So, which is great, and paid subscribers as well. So that's, there is a developing interest, I think. People are beginning to see the dangers, which we've been talking about, Liberty Finance for the last 10 years, I think, pretty much. They're beginning to see it. And I think it is desperately important that people do understand what's happening to their currencies, the consequences of government actions and all the rest of it. It is vital for their own personal survival. I mean, it's really as urgent as that.
Well, Alasdair, thank you as always for joining us here on Liberty and Finance for the benefit of all of our viewers and subscribers, not the least of which benefit of myself, to learn at your side as you clarify all of these moving pieces and help us to see them from perspectives that are very different from what we would get if we only listened to the mainstream financial press or official government sources, and those typical sources that most people rely on, that are not going to be giving them the perspective and the insights that they get here from you on Liberty and Finance. Thank you.
Thank you very much for having me on.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 21st through July 28th, 2025, while supplies last. First this week, we have a special on pre-1933 gold. MS62 $20 Liberty coins or MS63 $20 St. Gaudens coins
Are just $90 over melt. Own a piece of American history at just $90 over melt.
Next, backdated 1-ounce platinum eagles are only $270 over spot. And finally, Dealer's Choice 90% constitutional U.S. Mint silver dimes and quarters are just 65 cents over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.